Good morning. This is Horizon's Middle East and Africa, our top stories this morning. Asian stocks, bonds, and U.S. futures slip following stronger than expected U.S. jobs data. Traders are now pricing just one Fed rate cut this year. Oil climbs to a 4-month high as a fresh wave of U.S. sanctions against Russia threatens to hit supplies. Plus, as LA struggles to contain two blazes, more high winds are expected this week. It's just gone 8 a.m. across the Emirates. I'm Eugenia Victorino in Dubai, back from holidays. Happy New Year. This is my first show of the new year. It's good to be back. Looks like I've missed a lot of news, including a lot of talk about Greenland. But there you go. That was not in my bingo card for 2025. And it looks like we are going to keep up with this flow of news. But let's just start, as ever, with markets. Taking a look back at what has been quite a volatile start to the year. Major pullback in equities. Really interesting to note that for the week, last week, S&P was down about 2%. And of course, much of that to do with the very strong employment print that we had on Friday, surpassing expectations. And on the back of that, equities saw deep losses. And that's continuing into today's session. We've got S&P futures down about 0.5%, NASDAQ futures down 0.6%. In terms of next data points to watch out for, we've got U.S. inflation data coming up this Wednesday, UK inflation obviously in focus as well, given the move in yields there. In addition to the earnings season kicking off, we have banks earnings beginning at the end of this week. So something to watch out for from an equities perspective. But of course, all eyes have been on what's been happening with these yields. 10-year yields now closed for trading because it is a Japanese holiday, but sitting at around 4.76%. We are 25 basis points higher since the first trading day of this year. So that is a very long way to move in a very short amount of time. In terms of interest rate cut expectations, only about 25 basis points is priced into the curve this year. So the markets are pricing in one and done now as far as the Fed are concerned. So that is continuing to put upward pressure on yields, knock-on effects on equities. And then Brent also in focus. Take a look at what's been happening here. I've got to say, even me, I was surprised. I've been off for the past couple of weeks. We have seen a massive upward surge, 1.6% today, 4% higher on Friday, on the news that the U.S., one of Biden's last decisions in office, was to apply these sweeping sanctions on Russian tankers, on producers, on exporters, and the expectations that there could be some disruptions, which is why oil is up 6% over the course of the last 5 days. Other charts I wanted to point out, and this I thought was really interesting as well because it sort of crept up on me given how much equities have pulled back the last few days. But look, we've completely wiped out gains since the U.S. election day. So look, that Trump bump has completely faded now. So everything from the S&P to the NASDAQ to the Russell index is trading negative versus that election day. So interesting data point there. Okay, as ever, let's check in on how markets in Asia are faring. Avril Hong is in our Singapore studio with lots to unpack. Avril, given it's my first show back in the new year, Happy New Year.
Happy New Year and welcome back. Great to see you, Ju. We're seeing Asia stocks, unfortunately, today really on the back foot, coming under pressure. And it's declines mostly across the board. Tech is the big loser. We're seeing an outlier in energy stocks. But this is after that U.S. jobs report pushing back the rate cut expectations. But already stocks were struggling given the greenback strength, the problems in China. And today you add to that the elevated oil prices that are not helpful for Asia equities. So the region's benchmark ex-Japan at the lowest level since August. This is the fourth session of declines. The Chinese exports rising to a record. Given front loading, that's really cold comfort for Chinese equities. I also wanted to highlight what we're seeing in dollar China because it took a hit, the offshore renminbi last Friday following the jobs report. I won't go into the details, but the PBOC today deployed a number of tools to cap the weakness in the Chinese currency. So you're seeing it defying some of the losses among Asia currencies today. Jumana.
Yep, and keeping a close eye on what's been happening with the DXY, we are back to levels not seen since 2022. It is having knock-on effects on currencies everywhere, including the yuan. Avril Hong, thank you so much. Well, it's not just the USD that's in focus. Let's also talk about U.S. government bond yields, which are surging. The 10-year note approaching 5%. That is a level not seen since before the global financial crisis. The 30-year note, of course, briefly touching 5% on Friday as well. So for more, let's bring in Garfield Reynolds, who leads the Markets Live Asia coverage. And of course, our big take today is all about what's been happening with these bond yields. Garfield, let me Let me just start off by asking whether you think this rise in bond yields can be attributed to the strength of the U.S. economy, or is it on expectations of the policy impacts of once Trump steps into office and some of the measures that that administration will be taking?
Well, I think both of those factors have been acting to drive yields higher. The U.S. economy was in a very good position, before the election. It's continued to show strength. It's continued to look like an economy that is making the Fed's decision to cut rates in December look more and more questionable. Certainly those jobs numbers last week didn't scream, oh, this was an economy that needed a rate cut. So that's part of the picture. That's the economy as it is now before Trump takes office, before he carries out his policies. Now, those policies are a very mixed bag. They have some contradictions within them. However, cutting through that to look at what investors and analysts see as the base case they see is that, much as last time round, Trump will oversee a reflationary impact from government policy. So that means that the U.S. economy is already strong. It's likely to, at least in the short term, get even stronger. So all of that feeds into the potential for higher yields. It makes traders go, well, if you look at what's going on in the jobs market, you question whether we need the 2 rate cuts that the Fed has penciled in. And, when you think about what Trump is aiming to do, if he succeeds in reflating the economy even further, then, 1 rate cut might be too many. I think that's part of what's driving the action on that side. And then that's feeding through into these relentlessly higher Treasury yields.
Yeah. Let's talk about the knock-on effects it's having on other assets, and namely stock markets. And it is, of course, not gone under the radar that the S&P has pulled back quite significantly. Its worst day on Friday since the December Fed meeting. And I wonder, to what extent are we going to continue to see this higher yield, lower equities price action? At some point, is the correlation going to turn?
Well, the big thing that's concerning equity markets here is that the move in yields, as you alluded to at the opening, has been so rapid. When yields rise rapidly, and then also when they start to get to multi-year highs, that's what disturbs equities. That's what happened in late 2023, if I can remember that far back, when we had the sight of. That was when 10-year yields actually got a bit higher back then than they have so far this time, and that brought the stock market down until the Fed pivoted to make it clear it was going to cut rates sometime in 2024. So that's the situation we're in again, where the concern is that between the strength of the U.S. economy and the Fed, what that is doing to Fed policy, that's going to send borrowing costs sustainably higher, too high for equity markets to cope with, especially as there are some concerns emerging about the sustainability of earnings growth in the US. So higher yields, maybe weaker earnings, that's a bad mix for equities.
Yeah. Well, it hasn't been a good couple of weeks for risk parity trades, that's for sure. Garfield Reynolds, who leads the Markets Live Asia coverage. Thank you. All right, let's bring in Eugenia Victorino, head of Asia strategy at SEB. Good to see you, Eugenia. Well, investors have been quick to start pricing out the possibility of imminent rate cuts. Do you agree with that assessment? And do you think that the first rate cut could still happen in the first quarter of this year, or is it probably out of the question now?
Well, our official forecast is we are still expecting a rate cut in March, but given the totality of the data in the U.S., that's becoming more and more challenging to hold on to. Now, looking at the jobs report, it is very warranted that the Fed had actually taken a more cautious view. Having said that, the market is really going with the story that there would be less and less cuts, and now with only 1 cut that is priced in for 2025, I think that's just a little bit too little, considering the risks that are going to be coming in 2025.
You highlighted what you're penciling in versus the market's expectations. Do you think there could be perhaps a tail risk surprise of the next move out of the Fed actually being an interest rate hike, not an interest rate cut? Have you started thinking about that possibility?
Not really, not at this point, because at this point you still have so much uncertainty, at least as far as the incoming Trump policies are concerned. And that's the problem. The range of possibilities from the changes in the policy is just too wide. And because it's too wide, it's very difficult to have a very dominant driver for markets. So we've already seen that last week when you have rumors of changes or unexpectedly lower tariffs, you had market reactions even before Trump is already president. So now the market doesn't even know what to price in. The only thing that is clear here is that it is uncertain. The risk here is that we will have a very volatile market, but not necessarily form a trend.
What about the knock-on effects the yield moves in the U.S. are having on other markets around the world? We've been talking a lot about the state of the U.K. and what's been happening with yields there, but I look further afield towards some of these Asian markets, and China and Chinese bond yields seem to be living in a world of their own and continue to trend lower irrespective of what U.S. yields are doing.
Well, it's very understandable that the bond yields in China are going down, specifically because you have a lot of liquidity sloshing in the market, and yet there's very little investable assets, at least as far as the institutional investors in China are concerned. Now, looking at the foreign investor community, I think it's very difficult to see further sell-offs from them at this point. Having said that, the institutional investors within China are still very much attracted to the bonds, the government bonds, and looking at the growth potential in China, it is very likely that we cannot have a really sustainable increase in bond yields from here.
And let's just talk about the FX markets, especially today, because the PBOC pledged to strengthen the management of the FX markets and prevent large moves in the yuan. Not that dissimilar, actually, from what the Bank of Japan have been trying to do, at least with the jawboning, expectations building there that there may be a hike as soon as January. My question is whether you think these central banks are actually in a position to be able to do something to counter the strength of the USD here.
So as far as the PBOC moves are concerned, I think they are stuck in a very difficult position, because while a weaker yuan would probably provide more support to the economy, but they can't really allow the yuan to weaken into infinity unless they actually know what the U.S. Tariffs are going to be. And that is why we are expecting that the fixing will likely be maintained below 720 up until there is clarity on the tariffs. But as I said, there's too much uncertainty on the Trump policies. As it is, the 730 capping to 735 is already pricing in some increase in the tariffs even before Trump is in Washington. Now, our view is that if there is an increase in tariffs as to the Lighthizer plan, then that could actually lead to a weaker yuan towards 750 to 760. But the timing of that is very uncertain until we have clarity on the Trump policies.
Yeah, so many unknowns still, and he hasn't even taken office yet. That happens next week. Eugenia Victorino, thank you so much for joining, Head of Asia Strategy at SEB. Well, coming up, the wildfire threat in Southern California is far from over, with forecasts of dry, hot winds in the coming days. An update from LA is next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Bersachi in Dubai. At least 2 rounds of hot, dry Santa Ana winds are expected to blast through Southern California earlier this week. The powerful gusts are expected to challenge fire crews struggling to contain 2 destructive blazes and could force thousands more residents to evacuate. For more on this, let's go to Los Angeles now and speak to Bloomberg's Lucas Shaw. Lucas, just give us an update on the situation on the ground and also how the efforts have been to try to contain these fires.
Well, the winds that you referenced slowed down a bit over the last couple of days, which have given the firefighters an opportunity to make some progress, right? You know, the first day or two of these fires, it was hard for them to contain them at all. You couldn't even get kind of helicopters and other aircrafts in the air because of the speed of the winds to drop water and other things that could blunt the fires. There's been some progress made over the weekend. The Eaton fire, which is the second biggest fire, they now have, I think, about 25 to 30% contained. The Palisades fire, which is the largest fire, is between 10 and 15%. That's still not a lot, obviously. They have a lot of progress to do, but it's much better than where they were. We're all holding our breath because, as you mentioned, this week there will be sort of a new bout of very fast winds, and it's going to be very dry. And so we're hoping that we'll be able to contain the fires more before that happens, and that will not lead also to new fires.
And maybe it's perhaps a little bit too soon to talk about reconstruction, but I was seeing some reports suggesting that the total damages are more than $50 billion, $52 billion is the latest number that I've read. What do we understand about where the funding is going to come from for these reconstruction efforts?
Yeah, I mean, you're right. It's too soon to know. I mean, that number is going to keep growing. We know it's that the damage is considerable because we have entire neighborhoods that have essentially been wiped away. Right now, a lot of us on a personal level are more focused on just getting food and clothes to those who don't have it. But there's going to be, a lot of probably fighting between politicians and insurance companies and others over who funds what, right? There's so many homes that have been damaged. I think the estimates are that insurance companies alone will be on the hook for $15 to $20 billion, maybe more. I think President Biden has guaranteed some support from FEMA. Governor Newsom in California is trying to help. So it's going to require a collective effort. But yeah, the damage is really considerable.
Yeah, and as you say, the main focus right now is to contain those fires, which are still going. Bloomberg's Lucas Shaw in Los Angeles, thank you so much for the update. Now, coming up, a UBS Global Co-Head of Wealth Management, Iqbal Khan, shares his views on China and the Fed. That exclusive interview next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Bersechi in Dubai. The global co-head of UBS Wealth Management says Beijing's more proactive fiscal stance will be as relevant this year to markets as what happens in the U.S. Iqbal Khan also told us exclusively how he sees a slower pace of Fed rate cuts affecting investment decisions.
Well, generally, the entire rate curve and everything around rates policy, as well as inflation, has been a key topic and has now reignited again with what we're seeing in terms of the rate curve and what you just mentioned. There was a Bloomberg headline just this morning around scratching 5% in terms of 10-year yields. Having said that, we do still expect a gradual reduction in rates, but we will have to work through in scenarios. Why do I say that? We're waiting for an inauguration. We will see what the U.S. administration will be doing. There are scenarios out there. We need to work through those scenarios. We do believe that there will be continued rate cuts, maybe albeit a bit slower than anticipated, but this is something that we will have to work through.
You just said the Trump inauguration. He's threatened a lot of punitive issues, more protectionist American policy, including tariffs, as well as perhaps more debt issues. The deficit has been a problem in the United States. How do you see that impacting China in particular, which is trying to get some traction in its own economy?
Well, I think if you step back once again and you look at some of the macro challenges in China, we're talking about the real estate sector, we're talking about local government debt, and we're talking about consumer demand. We've started to see a commitment of China towards the economy, and we've started to see that economic policy come to bear. Everybody's, as you mentioned, waiting for March. We will see what the next steps around the more proactive fiscal stance will be in China. That will be as relevant as what the U.S. does.
You think that's what's going to happen in March? Because we've had some false starts, some false dawns, if you will, on the policy front. What would you like to see?
I think we would like to see continuous and sustainable steps towards addressing some of the more macro and fiscal challenges that China faces.
Will 2025 be tougher than 2024, though?
Look, every year, whenever we start a year, there's always this question, will one year be tougher than the other? One of the things that I've learned is don't always follow consensus. That was one of the things we learned when we went to Davos every year. Just think about scenarios, work through scenarios. You will always have additional information. One of the great things about GCC is figure out what is out there. What are the big knowns and what could be potentially the big unknowns, and how are you going to factor that in? Again, one of the key things that we are here to deliver is sustainable performance, sustainable impact for our clients. And we do that by making sure that their portfolios, their investment portfolios, are all-weather portfolios. And we work through this with our clients in making sure that they're diversified globally as much as by sector and theme.
Iqbal Khan, UBS APAC and co-head of UBS Global Wealth Management, speaking exclusively to Bloomberg TV. Now for a look at some of the other stories we're following today. Jamie Dimon says tariffs can help resolve issues of unfair competition and national security if used properly. But the JP Morgan CEO told CBS he has not spoken with U.S. President-elect Donald Trump about the subject. Trump has promised new levies on imports from China, Canada, and Mexico when he takes office next week.
He's a negotiator. He lays out some very tough things, and sometimes it works. We have to worry more about national security, resiliency, diversified supply chains, and we didn't. And also we should have worried more about who it hurt.
The U.S. Supreme Court has signaled it is likely to uphold a law that would ban TikTok if its Chinese parent company doesn't sell by January the 19th. A majority of justices suggested they see U.S. national security concerns as overriding the free speech interests of companies and content creators. ByteDance argues that TikTok is an American company incorporated and headquartered in California. And here's a look at equity futures. We are leaning towards the red after a negative week for Wall Street last week, with the S&P down more than 2%. Today, futures down about 0.5% for both the S&P and the Nasdaq Euro stocks, also down 0.4%. But coming up, foreign and Arab top diplomats gather in Riyadh to discuss the economic future of Syria. We get the latest with Natasha Hall, senior fellow at CSIS Middle East Program, next. Good morning. This is Horizon's Middle East and Africa. Our top stories this morning. Asian stocks, bonds, and U.S. futures slip following stronger than expected U.S. jobs data. Traders are now pricing just one Fed rate cut this year. Oil climbs to a 4-month high as a fresh wave of U.S. sanctions against Russia threatens to hit supplies. Plus, as LA struggles to contain two blazes, more high winds are expected this week. It's just gone 8:30 a.m. across the Emirates. I'm Jumana Versace in Dubai, getting you up to speed on some of these market moves because it has been a major week for market developments. The S&P down 2% over the course of last week, down 1.5% on Friday. Its worst day, well, since December, I should say, since the shockingly hawkish Fed meeting back in December. And what we also got was an upside surprise to that employment print on Friday, leading to yet another sea of red for Wall Street on Friday. The handover this morning, again, pretty negative. Futures leaning towards the red. S&P futures down 0.5%. We've got the Nasdaq futures down 0.6%. Later this week, we've got another data point to watch out for. U.S. CPI is going to be in focus. And then we've got U.S. bank earnings. So it's the beginning of the earnings season as well. That may help turn sentiment around for U.S. equities. But of course, the major catalyst has been what has been going on with yields. 10-year yields sitting at around 4.76% now. Closed for trading, given the Japan holiday. They'll resume trading again at 7 a.m. UK time. But Just to note that 10-year yields are about 25 basis points higher since the beginning of the year. On Friday, 30-year yields briefly touched 5% and came back again. And so the question is, when does this stop, and how much of an impact is it going to have on these other financial assets as well? That aside, we're also closely monitoring developments in the oil market. Today, you can see Brent is up 1.5%, trading almost at $81. It was not that long ago that Brent was trading close to $70. We're up 6% on the week. This on the news on Friday that the Biden administration is imposing sweeping sanctions on Russian exporters, producers, and tankers. And so we got about a 4% move on Friday. There is an expectation that there may be disruptions. We'll talk more about that on the show, but that's the picture for oil this morning. As for the terminal chart, one thing I did want to show you is ever since that hotter than expected employment report, and actually even in the run up to that, the market has been increasingly pricing out rate cuts from this market for the year of 2025. And now we're just settling at around 21 basis points worth of rate cuts priced in for 2025. So the market is pricing in one and done. And many analysts are trimming their expectations of how many rate cuts are going to come this year. Bank of America forecasting no rate cuts this year. So maybe it won't be too soon before we start hearing about people talking about the possibility of rate hikes out of the Fed. So that is the picture for Fed pricing. All right, let's also check in on Asia currencies. Avril Hong is in our Singapore studio. We were talking about the strength of the USD in parallel to what's been happening with US yields. What are the ramifications on some of these Asian currencies?
Yeah, we're seeing Asia FX, particularly in the EM complex, getting hard hit. And it's really drawn all these central banks in defense of their currencies. You hear from Bank Indonesia today pledging defense of the rupiah. But it's really about how the greenback strength shows no signs of abating. And interesting today to see how the renminbi and the Japanese yen are managing a bit of a recovery. On the yen, there is positioning underway potentially because of a big speech that's due from the BOJ Deputy Governor that some see as the last chance for the central bank to telegraph tightening later in the month at its meeting. But the renminbi today, if you flip the board, as you see a bit of a recovery from almost record lows last Friday, it actually, the PBOC deployed a number of tools in support of the yuan. Strong fix, 1,500 plus pips versus estimates. Verbal warning as well. It said, they would kind of deal with the behaviors that disrupt the market order, but also interesting how it tweaked capital control. So firms can borrow more from overseas, although that being said, it remains to be seen how effective such a move would be, given how there's in general an unwillingness to lend to Chinese firms. But for the moment, that's helping to cap the declines in the renminbi. Jumana?
Avril, thank you so much for the overview. Avril Hong in Singapore. Now, switching to geopolitics, Saudi Arabia's foreign minister has called for sanctions on Syria to be lifted after meetings with top diplomats. Delegates from the Middle East and Europe met in Riyadh on Sunday, with EU foreign ministers now set to gather later this month to discuss their next steps. Let's bring in Natasha Hall, Senior Fellow at CSIS Middle East Program. Natasha, good to have you with us. Maybe let's just start actually with the developments from Riyadh over the weekend and the fact that so many of these diplomats around the world are moving towards acknowledging the transitional government that is in Syria. To what extent do you think that the HTS now government, transitional government, is going to be able to cling on to power? What is your view of the longevity of this government in the absence of sanctions being lifted?
Thank you so much, Jumana, for having me. What's happened over the course of the past few weeks is just simply mind-boggling. HTS has gone from a pariah terrorist organization, it's hard to believe, to this transitional central government in a matter of weeks. Ahmed al-Shara, the leader of the organization, just recently had a $10 million bounty on his head that was recently removed. And he's been receiving a litany of foreign dignitaries and ministers over the past month. But it still remains all of these sanctions that are just overwhelming on Syria, not to mention HTS's foreign terrorist designation, Syria's state sponsor of terrorist designation as well, which prohibits a lot of investment, World Bank and IFI investment and loans, in addition to more spending on reconstruction, which is so vitally needed. And all of this is really needed very, very quickly to shore up the refugees that will be returning home, the internally displaced people that will be returning home, and really everyone who is hoping and waiting for a brighter future in Syria. Now, if that doesn't happen, I suspect that there will be many nefarious actors at play, both internal and external, into Syria that will try to take advantage of the kind of despair that we have seen in Syria for the past over 13 years.
Yeah, which is why the international community probably wants this to succeed, assuming the government does the right things. Let me ask you a question about Saudi Arabia, because it feels as though in the last couple of months they've been playing an increasingly muscular role when it comes to diplomacy in the region. Notable that Saudi representatives actually flew to Lebanon before the Lebanon presidential elections. They've met with Syria. They've obviously hosted all these diplomats in Riyadh. What do you think Saudi Arabia is trying to achieve?
Well, I think that Saudi Arabia is trying to have a major role in all of this major shift in geopolitics in the region. We've seen Iran tremendously weakened, but we have seen also Qatar and Turkey come into play almost immediately in places like Syria. And I think Saudi Arabia just wants to ensure that it has a significant role to play in all of these countries that have just experienced quite a bit of devastation, but also possibly renewal, as is the case with Lebanon itself, but many other parts of the region as well. And I suspect that that's why they're also advocating now for lifting sanctions on Syria, because they will want a piece of the sort of influence pie, if you will, within the region, both in Lebanon and in Syria, to also prohibit, I think, the reemergence of Iran or any other sort of actor in the region or beyond.
Well, speaking of Iran, Trump takes office in a week's time, even though it feels like he's already in office. He's talked about maximum pressure on Iran. Do you think there's a deal to be done there? Say Iran saying that they will provide less sponsorship to their proxies around the region, stop with the enrichment program in exchange for the lifting of sanctions. Do you think that that could be something we could see this year?
I think it would be possible, but it's really hard to say because there are so many Iran hawks that are demanding sort of maximum pressure for Iran rather than negotiations at this moment of extreme vulnerability with Iran. Now, that could be an interesting tactic because what we've seen from Iranian officials in recent weeks is really trying to project strength, even when it's in a state of extreme vulnerability after Israeli attacks on Iran itself, on its proxy Hezbollah, and the loss of Bashar al-Assad in Syria. But what they've been trying to do is really talk up their alliance with Russia, saying that it's more powerful than ever before, that it's engaged in these war games in the past few weeks, and also has been talking about quote unquote special missiles that it's creating as well. So I think Iran is really trying to play up its strength right now before Trump comes into office, but I don't think it will necessarily have the effect that they want on the Trump administration.
Yeah. Well, let's see how this all plays out. Natasha Hall, always good to talk to you. Senior Fellow at CSIS Middle East Program. Thanks. Now, coming up, growing signs that Dubai's record property market rally is slowing. We'll discuss why developers are becoming more cautious next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Bersachi in Dubai. Shiny new towers and villa communities will again spring up in Dubai this year. That's as developers pile into one of the world's biggest property booms. Yet there are growing signs that the record rally in house prices is slowing. Let's get more with Bloomberg Zainab Fatah. Interesting. We were talking about a slowing rally in house prices. That doesn't appear to be the case ever. But talk to us about the expectations for 2025 and what some of these developers see happening.
Well, it's been a very, very breathless rally for the developers. They've been selling property. They have record numbers of sales. And the expectations that in 2025, we're going to see property prices increase, but at a much slower rate than last year. So the expectations that in 2025, we will see Dubai up 8% on average, the prime around 5%. That compares with 2% for London, 3% New York. So it's much faster, despite the fact that we have seen last year prices go up around 20%, and the rentals have outpaced the increase in prices. Shows you that the real demand for occupants is really strong. And that's why the market has been on this boom that ended 7 years of decline and around 2020, and we've seen it carry on despite many of us expecting it to slow year after year.
Yeah.
It kept going.
Yeah, but what are some of the signs suggesting that we are bound to see slowing growth? Is this just a knock-on effect from some of the international dynamics that are taking place, or something else?
Probably the international dynamics definitely have to do some part to play here, but we have seen the market itself grow in a massive way that left a lot of people feeling we are hitting a ceiling. Prices have surged over 50% in the past 4 years. We've seen rents increase in a massive way. And in a way, Dubai wants to ensure that it can remain affordable for all these people coming in, at the same time be a destination for investors. And that's why the biggest developer in Dubai, Emaar Properties, their focus next year is going to be on completion and selling their properties, and they will limit the increases in the prices they sell to first-time buyers of homes, what is called off-plan, when they sell homes before construction.
Interesting. So it's slightly more managed than it was in the past. Yeah.
That's what they're aiming for.
Yeah. Zainab, thank you so much. Well, that was Bloomberg Zainab Fatah giving us an overview of Dubai and the Dubai real estate market. Meanwhile, Saudi Arabia's housing supply is under pressure. The kingdom needs to build more than 100,000 homes per year for 6 years to meet demand and to hit government targets. So let's bring in Elias Bou Habib, CBRE Head of Consulting for Saudi Arabia. So we just got the look on Dubai and the outlook for 2025 in the UAE and specifically in Dubai. Let me just ask you the same question in Saudi Arabia. And when we talk about the real estate market in Saudi Arabia, clearly the focus tends to be around some of the metropolitan cities like Riyadh and Jeddah. Just break it down for us.
Sure. Good morning, Jumana. Thank you for having me. So if we look at the real estate sector in Saudi Arabia, we know that it is one of the 13 sectors that the Vision 2030 is focusing on. And we know that the performance of the real estate sector is mainly driven by the performance of the economy overall. So if we look at the Kingdom of Saudi Arabia, we see that the GDP has been increasing during the last few years. It has increased by 1.4% 2024, and it will expected to increase by 4.4% in 2025. So although there is like a downgrade of the expectations due to the oil market, however, the non-oil sector is contributing a lot to the growth of the economy, which has been around 4.5% in 2024, expected to grow to 5.8% in 25% in 2025. So having said that, the reason why I'm saying that because all these factors are playing a big role into the growth of the economy and therefore growth into the real estate sector, adding to that the cuts in the interest rates, which play a very important role in the real estate market, the inflation, which has kept around the 2% in 2024, and it might slightly grow to 2.3% in 2025. So having said that, we think that the continued rate cuts and the economic growth will be combined with a sustained government investment in Saudi Arabia, therefore will continue to drive the real estate sector in the future.
Yeah, well, thank you for laying out the thesis for us, in addition to listing some of those macro developments which will aid the real estate market. But what role does the Saudi government, some of these Saudi government initiatives play also in enhancing the real estate market? For example, just to give you an example, I'm curious to hear what's been happening in the real estate, on the commercial real estate side of things, given the introduction of the RHQ program. Is that having an impact at all on office occupancy rates?
Yes, definitely. So if we take the different types of the asset classes and we start, for example, with the offices, as you mentioned, we notice that Riyadh is still the main focal area for all the occupiers, because with the increasing number of companies that are relocating to Riyadh due to the HQ program, there is more and more demand for office spaces. We know that the supply at the moment is constrained by the availability of office space. Like the occupancy rate now in Saudi Arabia is somewhere around the 98%. And the rentals are increasing by around like 20% on a yearly basis. But this is mainly driven by the lack of availability of office supply. However, we know that there will be new office supply coming to the market in 2025 during the second half, which will add another 4 to 5 million square feet to the existing stock of office space. However, even though there is like still more supply, we believe that the demand on office space will continue to grow and the rents will also continue to grow.
What about on the residential side of things? How has the influx of expats into Saudi Arabia influenced the residential market?
So the residential market in Saudi Arabia has been among the strongest, like compared to the other asset classes as well. And this is mainly driven by the growth of the population, the influx of foreigners coming into the country. So all these are playing a very important role when it comes to growing the demand for residential real estate. So if we look at the number of transactions, Jumana, we see that it has increased by around 31% in Riyadh last year, and we believe that this is going to continue to grow in 2025. If we add to this like the prices of villas, we see that the average price of villas in Riyadh has increased by around 5% during the last 12 months. The prices of apartments have increased by around 4%. We think that this is also going to continue in 2025 as well.
Interesting. Well, a good place to leave it then. Elias Bou Habib, CBRE, Head of Consulting for Saudi Arabia. Thank you so much for coming on Horizons today. Well, for more of these stories looking into the intersection of wealth and power in the region, sign up for our Mideast Money newsletter on Bloomberg.com. Coming up, Ethiopia launches its stock exchange with just one listing in a bid to broaden its economy recovering from a civil war. We'll have the details next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Versace in Dubai. Ethiopia has launched its stock exchange with just one listing. It's part of a plan to attract investors to its economy recovering from a civil war. The exchange opened without any brokers and no initial public offering debuts. For more, Bloomberg's Fasika Tadesse is in Addis Ababa in Ethiopia. Fasika, good to have you with us. So obviously a big day for Ethiopia, the fact that the stock exchange is up and running, but it's only got one stock listed. And I just wonder what that speaks to of the challenges Ethiopia faces in establishing a successful stock market and these deep capital markets.
Thanks, Jumana. So as you said, the stock exchange has been launched last week on Friday, January 10th, and just one local bank was listed on the stock exchange. And also there was no initial public offering. We were expecting Ethio Telecom, the state telecom giant that launched the initial public offering in October will be listed on the stock market, but it was not. So there is also no international company in the broker to be secured a brokerage license from the government. No custodian is operating in the country. So it seems that there needs to be done a lot to build the confidence of the local investors. At the same time, the international companies to come and invest in Ethiopia and secure brokerage or custodial license. And also the other challenge is the economic challenge. As you know, last year, the inflation was recorded at 17%. So these are the challenges,
What are some of the steps that the government can take to attract foreign investments?
The first challenge that could be is repatriation of funds, especially for the international investors coming into the Ethiopian Stock Exchange. So building a confidence on the companies that they could take out funds that could be invested in the capital market would be one of the strategies the government could do. And obviously, there is a law that says that they will get priority in repatriating the funds they invested in the capital market. But also, there needs to be additional laws that will build the confidence of international companies to come and invest in the country, so that they can repatriate or they can take out the funds they invested in the markets.
Very clear. Bloomberg's Fasika Tadesi in Ethiopia. Thank you for bringing us the story. A big day in Ethiopia with the launch of the stock exchange. And that was our colleague just going through why it is so important and also some of the challenges ahead to establish a more liquid capital market. All right, a look at equity futures before we head out. This is capping the first hour of Horizons. And here you can see all of the equities are leaning towards the red after a negative session for Wall Street on Friday. The catalyst there, of course, being the stronger than expected employment print. Also keep an eye on inflation expectations moving higher as well. So both of these things impacting the performance of equities and yields as well, which have climbed 25 basis points since the beginning of the year. But coming up in the next hour, we discuss the global fixed income outlook with Omer Chowdhry from Aditum Investment Management. I'm Jumana Versace in Dubai. Stay with us as Jennifer Zabazaja joins me next. Good morning. This is Horizons Middle East and Africa. Our top stories this morning. Asian stocks, bonds, and U.S. futures slip following stronger than expected U.S. jobs data. Traders are now pricing just one Fed rate cut this year. Oil climbs to a 4-month high as a fresh wave of U.S. sanctions against Russia threatens to hit supplies. Plus, as LA struggles to contain two blazes, more high winds are expected this week. Well, good morning. It's just gone 9 a.m. across the Emirates. I'm Jumana Versace, back in Dubai and happy to be reunited with Jennifer. Jen, I haven't seen you since the New Year, so Happy New Year from Dubai to Johannesburg.
Happy New Year, Jumana. It's great to have you back. Hope you had some nice time off. It's great to be here. I'm Jennifer Zabasaja in Johannesburg, where it's just gone at past 7 a.m. Welcome to the second hour of Horizons Middle East and Africa.
Well, Jen, if I thought it was going to be a sort of easy start to the year, I am definitely thinking again, looking at the news flow that I missed over the last couple of weeks, everything from politics, geopolitics, and of course, markets. So let's run you through some of the price action. Friday, the big event was that NFP number coming in much hotter than expectations. And on the back of that, so many analysts have now changed their forecasts for what they're expecting out of the Fed this year. The likes of Bank of America, for example, no longer expecting a rate cut at all out of the Fed. So that is having an impact on equity markets. Wall Street saw a pullback on Friday, S&P down 1.5%. Today, futures also leaning towards the red, down 0.4%, NASDAQ down 0.6%. Later this week, we get CPI data, so we'll see if that also comes in hot. Then again, yet another signal that the Fed may have to sort of keep rates restrictive for longer. But then we also have the beginning of the earnings season with many of the big banks starting the earnings reports towards the end of this week. So it is gearing up to be quite a busy week. U.S. Treasuries, again, still in focus, 4.75%, not trading now because it's a Japan holiday. They'll be back in action at 7 a.m. UK time, but still a significant move higher over the course of the last couple of weeks. On Friday, the 30-year yield briefly touched 5%. So yields continue to creep higher. That is having knock-on effects everywhere on equity markets and on the USD as well. And then Brent in focus today continues to move higher as well. From about an hour ago, we were about 1.5% higher, now almost 2% higher, creeping back towards $82 on news that the U.S., the Biden administration, And one of his last decisions actually have imposed these sweeping sanctions on Russian exporters, producers, and oil tankers. So the expectation is that there may be some disruption there. Oil prices were up 4% on Friday. As for our terminal chart, I thought this was interesting. Just taking a look back and zooming in at the price action the last couple of months. Take a look at this. We've been talking about the Trump trade. Remember the Trump trade? So that's long equities, short fixed income, long USD. Well, two out of those three have worked out. Equities, not so much anymore. And if you go back to the November election date, everything from the S&P to the NASDAQ to the Russell is now trading underwater. So negative now since the election days. So that is pretty interesting, I thought. Okay, let's also check in on China markets. This morning, we had some data come through, trade data, in addition to some announcements from the PBOC on the yuan. Avril Hong is in our Singapore studio. Avril, just run us through the latest.
Yeah, Jumana, we're seeing how Asia's stock gauge ex-Japan is at its lowest level since August. And chief among the culprits are what you're seeing in Chinese equities. Indeed, if you look at the MSCI China, it's pulled 20+% away from its October peaks. And this is against the backdrop of stimulus, disappointment, tariff uncertainty, some of these economic indicators that really show the Chinese economy needs more in the way of stimulus. And amid all this, you're hearing from the PBOC governor making an unexpected appearance at a Hong Kong forum, saying they're kind of shifting the policy focus away from consumption, away from investment, I should say, towards consumption. And this is a growth model that's pretty much defined China for the past 2 decades. So on the face of it, this is something that's seen as supportive, but the trouble with Chinese equities really is the lack of confidence. So until we see tariff, stimulus, clarity, we're going to see these pressure coming on Chinese stocks. You see the MSCI China down about 0.8% as we're back from the lunch break, Jumana.
Yep. Avril, thank you so much. That was Avril Hong in Singapore.
Now, let's get back to the markets. U.S. government bond yields are surging with the 10-year note yield approaching 5%, a level not seen since before the global financial crisis. For more, let's bring in MLive strategist Mark Cranfield, who is joining us. So, Mark, we just had Avril there walking us through some of the malaise that we are seeing throughout Asian markets. What would you attribute this to?
Oh, it's a number of factors all coming together at just the wrong time, really. So you've had, as you were mentioning earlier in the program, the non-farm payrolls numbers were pretty hot coming out of the United States. And if anybody thought the Federal Reserve was going to be able to lower interest rates, they really got to reconsider that, because the unemployment rate is down to just 4.1%, plus a very strong payrolls figure in the terms of the non-farm. So all in all, the conditions really are that the American economy is very strong. The Federal Reserve is very clearly going to be holding interest rates, and for some time it looks like, and this is even before Donald Trump has become president, and there's every chance that he will try to lower taxes, try and boost growth even more in the United States, which doesn't really seem to need it. So that could well become an inflationary issue. Now we have the US imposing tougher sanctions on Russia, which is pushing up oil prices, which is immediately going to inflect the inflation picture as well. So you've got bonds don't like it. The people in the bond market were getting used to the idea that the Federal Reserve would lower rates. That's not so much the case. Now inflation is coming back as well. The yield curve is steepening. People are getting very concerned. 5% might not be the stopping point. We might have to soon start discussing even higher levels for Treasury yields as well. All in all, none of that is a supportive backdrop for Asian currencies, for emerging market currencies, and that then feeds in to a bearish situation that you have right across Asian markets, as Avril was talking about earlier.
And Mark, let's just stay on currencies, because right now we're seeing the pound the worst performer among major currencies. You actually have a note out about how we should expect more punishment for the pound as Rachel Reeves holds the line on fiscal policies. Dig into that a little bit.
I mean, already starting last week, traders were already getting nervous about the UK situation. They run dual deficits, the fiscal and the current account deficit, both pretty large by global standards. Traders were beginning to exploit that, pushing against the pound. You've had this budget which came towards the end of last year from the new Chancellor in the UK, Rachel Reeves, and she drew some fiscal rules within that, which are now being challenged already because yields have gone higher in the UK market. Over the weekend, she says those rules are non-negotiable. Now, when you say that to financial markets, that's just like an invitation for them to go and attack you. So foreign exchange traders will see that, and they'll just be emboldened to go even further after the pound. If you look at what the option market is saying, it's suggesting the pound could drop another 8% before it's some kinds of stability. On top of all that, you have the Bank of England in a very difficult situation. They would like to lower interest rates, but when they look at the chaos in the bond market and the weakness of the pound, it makes their job more difficult as well. It's really like a very nasty cocktail. It's all coming together at the same time. There's no easy way out. And when you've got a very strong US dollar in the background, it looks as though the pound will have to get weaker first.
Oof, not something that the Chancellor will want to hear. But MLive strategist Mark Cranfield, always appreciate your insights. Thanks for joining us.
All right, let's continue the conversation now with Omer Chowdhry, Head of Global Fixed Income and Multi-Asset Strategies at Aditum Investment Management. It looks like we've gone back to the mantra of good news on the economy is bad news for stock markets. What do you think is going on?
Absolutely. So obviously it's been a messy start to the year. We've seen this relentless climb in yields that started in mid-September, and that's due to a recalibration of inflation expectations, and that's repricing monetary policy. And so the stock market, which got excited about, Fed rate cuts coming in and the cutting cycle continue, are kind of rethinking that whole scenario. And, higher rates are an impediment to risk assets, especially growth stocks, so they're starting to feel the pain over there.
Yeah.
And so we think there is a chance of a correction in risk assets, including credit maybe.
Yeah, that's interesting because honestly, I did a lot of these look-ahead interviews in November, December, and everybody was optimistic about where the U.S. was heading. And there's this view that U.S. exceptionalism was going to stay with us and that U.S. stock markets would continue to outperform. Now it seems like that there's a recognition that, yes, valuations are rich, but also there's a lot of uncertainty about policy and the direction that the Trump administration is going to go in.
Yeah.
Given that backdrop, why would you continue to invest in equities?
So we're a bit cautious. Indices are up a lot on a 2-year basis, if you look. We're selective in equities, so we think that the AI theme probably still stands dominant and prevails. Though we think the path for stocks is going to be a lot more volatile than it was in 2024. In 2024, equity volatility was quite suppressed. We think we see heightened volatility, and we think that U.S. stocks will be attractive on a tactical basis at lower levels. But at current valuations, we're probably pretty cautious, and we'd rather cut risk and sit in a bit of cash and see how the next month plays out.
Yeah, it certainly makes sense to do so, and that those are the signals that equity markets are giving you. Let's switch to fixed income. The 30-year yields almost touched, briefly touched 5%. On Friday, people say that 10-year yields are going to hit 5% next. Is that a buying level?
It was a couple of years ago. Let's see how it pans out now. It could be, except the only difference now in 2023 is that there's a new administration. And like you mentioned, there's a lot of policy uncertainty. Are they going to remain pro-growth and give disregard to the fiscal deficit problem and the ballooning debt that they have? And I don't think market gets clear and straight answers on that. That's going to be more of a longer-term issue. And until then, I think bond investors are going to remain pretty cautious, and so yields can remain elevated. 5% probably becomes a magnet, right? I think on a real return basis, it depends on what your expectations for longer-term inflations are, right? So if you look at the 5-year forward inflation expectations, they're slowly ticking higher, but they haven't become de-anchored yet.
Yeah.
And so I think we have to wait and see how some of these policies pan out. But I think some people will probably step in and start buying around the 5.25 level.
Just because psychologically it's a nice level. And just your point on inflation expectations, I thought it was really interesting on Friday. Alongside the NFP, you also had Michigan 5 to 10-year inflation expectations rise to 3.3%, the highest since 2008. So what does that tell you about the Fed and their ability to keep inflation expectations under control? I mean, if you look back at all of the things they said in the last 6 months of the year, there was a lot of flip-flopping.
Yeah. I think the way that the transmission mechanism in the economy, after they pumped so much money post-COVID, has kind of changed the landscape, and the Fed has had challenging time trying to figure out where inflation is going to go, where the economy is heading. And it's unusual, like, that you've cut 50 basis points and now you're backing off. I mean, they did 100 basis points last year and done. But I think that the Fed is going to take a bit of a cautious stance, considering that they were behind the curve in inflation and they don't want to cut too soon and let inflation rise again. I think that, the economy is booming and consumer spending is still elevated. I think part of the reason for that is that financial assets are going a lot higher, and that's very loosening of monetary conditions. And when stocks go up, U.S. consumers spend. the ones that own stocks and don't either. So it's all a cycle that feeds on itself, right?
Yeah.
If rates go much higher, risk assets can correct. That might cause the Fed to step in and start cutting a bit more aggressively.
Right, but the backdrop is the U.S. economy is still doing pretty well.
Still doing
so
well.
what does that mean for corporate credit then?
So corporate credit fundamentals generally have been pretty good. But if rates keep going higher, then the bar for refinancing, refunding does become a bit of a question, especially for low quality credit. But supply has been pretty limited for the most part, and demand has been pretty high. So those dynamics have been driving credit spreads pretty tight. But again, I don't think credit spreads remain immune in this environment if rates keep going higher and stay there for a long period of time.
Okay, top call into 2025. What's your top call?
Tough one, but I think that we like gold as sort of a hedge in the portfolio, but it's also challenging because if real yields keep going higher, gold, will have a bit of an obstacle going higher.
Yeah.
But we're going to probably add that to our portfolios. U.S. equities on lower levels as a tactical play, specifically in the AI theme, and then maybe Japan stocks as well, because we think the backdrop there is pretty strong. And the Bank of Japan is going to pretty much raise rates, which will strengthen the currency and cause inflows into that market.
Yeah. Okay. Great place to leave it. Omer Chowdhry, Head of Global Fixed Income and Multi-Asset Strategies at Aditum Investment Management. Well, coming up, diplomats gather in Riyadh to discuss the economic future of Syria. We get the latest next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Versace in Dubai. Saudi Arabia's foreign minister has called for sanctions on Syria to be lifted after meetings with top diplomats. Delegates from the Middle East and Europe met in Riyadh over the weekend, with EU foreign ministers now set to gather later this month to discuss their next steps. For more on this, Stuart Livingstone-Wallace, Bloomberg's executive editor for Middle East, North Africa and Russia, joins me now. Interesting that Riyadh hosted this mini summit, I would say, to talk about the future of Syria, the direction of travel, but then also putting out this statement that it's probably time for the West to think about removing and lifting sanctions. Talk to us about why you think Saudi Arabia are playing an increasingly important role in this part of the world.
So, I think there are basically three main players in this one, which is Saudi Arabia, yes, Qatar as well, playing that sort of mediator role, and obviously has the cash as well to do that, and we've already seen some of that going in. And then on the other side, Turkey, which is going to be, I think, problematic in the sense of finding a consensus between those parties about what the future of Syria looks like going forward. But I think in terms of Saudi Arabia, it has always viewed itself as having that preeminent regional role. It is not unusual in those circumstances that it would want to be the leader here as well. And I think as far as the West is concerned, it's quite useful to have an ostensibly Western ally leading those talks and hosting those talks.
Stuart, what is the likelihood these sanctions actually do get lifted? Certainly HTS, the transitional government, seems to be saying the right things, sort of moving in the right direction. Is it likely we see the sanctions actually get lifted? And would that be a huge moment, do you think?
I think it'll be a temporary thing. So in other words, it looks like on a rolling sort of 6-month basis, because understandably, given that at least some of the senior leadership in HTS continue to be sanctioned themselves for their previous affiliation with Al-Qaeda and other fairly unpleasant groups. There's a sense that if they lift all the sanctions immediately and then things get out of hand in Syria, they're going to have to bring them all back to square one, and that's not a good look for anyone. So I think it's cautious optimism, and as you say, the leadership is saying the right things. There does appear to be a growing consensus within Syria about what that might look like going forward, but a nervousness.
It is pretty remarkable what happens in the region in the last couple of months of the year, and even in Lebanon, finally, a president was elected. Now there's talk about what the new cabinet is going to look like. Prime ministerial consultations are taking place. But I just wonder whether, in the case of Lebanon, there's a view out there that going forwards, Lebanon will be less of a stronghold for Iran and Syrian influence that it was in the past.
I think that's the hope. Now whether that transpires is a different thing, because Hezbollah has not gone away. It is much diminished, for sure. Most of its experienced leadership are dead, and most of the weaponry has been eliminated, or at least the heavy weaponry. But nonetheless, this is a group whose entire raison d'etre is to destroy Israel and to basically control power within Lebanon. But as you say, I think the recent election of the president is a really positive sign. It is, in effect, a rejection of that Iranian influence, and by extension, the Syrian influence, which itself under Iranian influence. So again, it's a positive step, and I think everyone is really, really hoping that momentum can continue, because again, people are looking at the potential of Lebanon, as people always have looked at the potential of Lebanon. And so that is potentially something that could be a real game changer for the region.
Well, let's see what happens when Trump takes office in a week's time. It could all change. Stuart Livingston-Wallace, thank you very much for the latest. Bloomberg's executive editor for Middle East, North Africa, and Russia. Now, coming up, UBS Global Co-Head of Wealth Management, Iqbal Khan, shares his views on China and the Fed. That exclusive interview next. This is Bloomberg.
Welcome back to Horizons, Middle East and Africa. I'm Jennifer Zabasaja in Johannesburg. The global co-head of UBS Wealth Management says Beijing's more proactive fiscal stance will be as relevant this year to markets as what happens in the U.S. Iqbal Khan also told us exclusively how he sees a slower pace of Fed rate cuts affecting investment decisions.
Well, generally, the entire rate curve and everything around rates policy, as well as inflation, has been a key topic and has now reignited again with what we're seeing in terms of the rate curve and what you just mentioned. There was a Bloomberg headline just this morning around scratching 5% in terms of 10-year yields. Having said that, we do still expect a gradual reduction in rates, but we will have to work through in scenarios. Why do I say that? We're waiting for an inauguration. We will see what the U.S. administration will be doing. There are scenarios out there. We need to work through those scenarios. We do believe that there will be continued rate cuts, maybe albeit a bit slower than anticipated, but this is something that we will have to work through.
You just said the Trump inauguration. He's threatened a lot of punitive issues, more protectionist American policy, including tariffs, as well as perhaps more debt issues. The deficit has been a problem in the United States. How do you see that impacting China in particular, which is trying to get some traction in its own economy?
Well, I think if you step back once again and you look at some of the macro challenges in China, we're talking about the real estate sector, we're talking about local government debt, and we're talking about consumer demand. We've started to see a commitment of China towards the economy, and we've started to see that economic policy come to bear. Everybody's, as you mentioned, waiting for March. We will see what the next steps around the more proactive fiscal stance will be in China. That will be as relevant as what the U.S. does.
You think that's what's going to happen in March? Because we've had some false starts, some false dawns, if you will, on the policy front. What would you like to see?
I think we would like to see continuous and sustainable steps towards addressing some of the more macro and fiscal challenges that China faces.
Will 2025 be tougher than 2024, though?
Look, every year, whenever we start a year, there's always this question, will one year be tougher than the other? One of the things that I've learned is don't always follow consensus. That was one of the things we learned when we went to Davos every year. Just think about scenarios, work through scenarios. You will always have additional information. One of the great things about GCC is figure out what is out there. What are the big knowns and what could be potentially the big unknowns, and how are you going to factor that in? Again, one of the key things that we are here to deliver is sustainable performance, sustainable impact for our clients. And we do that by making sure that their portfolios, their investment portfolios, are all-weather portfolios. And we work through this with our clients in making sure that they're diversified globally as much as by sector and theme.
Iqbal Khan there, UBS APAC and co-head of UBS Global Wealth Management, speaking exclusively with Bloomberg TV. Now let's take a look at a few other stories we're following this morning. First off, Justin Trudeau says Canada is ready to respond with counter tariffs against the U.S. if President-elect Donald Trump follows through on his threat to begin a trade war. The Prime Minister told MSNBC that Canada isn't looking for a trade fight, but will respond if needed. Bloomberg sources say one draft retaliation plan would affect almost every product category imported from the U.S. And a quick check at where markets are positioned ahead of the trading day, pointing to the red when we do see markets open later today for U.S. equity futures right now down about 0.5% for the S&P futures, and NASDAQ 100 futures just down about 0.6%. Of course, we're paying close attention to what we get from the U.S. inflation print later this week. But coming up right now, little sign of relief for exhausted California firefighters. More on that next. This is Bloomberg. This is Horizons Middle East and Africa, our top stories this morning. Asian stocks, bonds, and U.S. futures slipped following stronger than expected U.S. jobs data. Traders are now pricing in just one Fed cut this year. Oil climbs to a 4-month high as a fresh wave of U.S. sanctions against Russia threatens to hit supplies. Plus, as LA struggles to contain two blazes, more high winds are expected this week. It is just gone past 7:30 a.m. in South Africa. I'm Jennifer Zabasaja in Johannesburg.
And I'm Joanna Versace in Dubai, where it's just gone 9:30 a.m. Welcome to the second half of the second hour of Horizons Middle East and Africa, Jen.
And it's great to have you back, Jumana. Hopefully you had some nice time off. But really, 2025 is setting us up for quite a busy week, and we're only a few weeks into it. Let's just take a look at where markets, though, are positioned ahead of the trading day. As you can see, U.S. stock futures pointing towards a lower open, though it is a data-heavy week for traders. We are going to be waiting for U.S., U.K., and Germany CPI that's going to come later in the week. We also will get some Fed speak in addition to the start of major corporate earnings from big banks. But as you can see right now, U.S. equity futures pointing it down in the red. And that comes after we did see all three major indices actually closing in the red for a second consecutive week last week. That coming after we did get that stronger than expected labor report from the U.S. I'm also watching closely what is happening in emerging markets, as we typically do. The MSCI Emerging Markets Index down as well, really being hurt by that stronger report, down for a fourth day right now, as we see that jobs data really dampening bets of further rate cuts from the Federal Reserve. And oil, a different picture what we're seeing with oil than we've seen actually for the last few months. Oil, Brent crude trading above $81 a barrel for the first time in 4 months. And that is coming after we did hear that the U.S. was imposing more aggressive sanctions against Russia's oil industry. And just to bring you this terminal chart to dig into that a little bit more, Brent now hitting this new high for the first time in several months, as we can see. And of course, we are awaiting what we do get from President-elect Trump when he is inaugurated next week, potentially ratcheting up even more tension globally. But this is where we are right now when it comes to oil. Let's check in, though, on how markets in Asia are faring. They've had quite a bit of activity over there. Avril Hong, though, is standing by in our Singapore studio for more. Avril, what are you watching?
Well, Jen, we're taking a look at Asia currencies against the backdrop of the greenback strength that is showing no signs of abating, the shift in Fed expectations, also really hitting Asia currencies hard, including those in the EM complex. And you're seeing how the Asia dollar index, this is a Bloomberg gauge of FX in the region, excluding the yen, is hitting the lowest level since 2006. So just to give you a sense of what this is going to mean for Asian central banks, we've already been seeing them, sort of getting their calculus shifted as the expectations for the Fed moves. The RBI, for example, some of our analysts have already pointing out that might draw intervention, but for the Indian rupee, it might be more about curbing volatility rather than targeting specific levels. The rupee today actually hit a record low for the Japanese yen. The weakness in the currency has been exacerbating import inflation. So the expectation is that the BOJ sort of says things to kind of cap the expectations, and we're seeing how late last week there were reports that it might shift its inflation outlook. When you look at the PBOC, it's also broadened its support measures for the yuan. But similar to the outlook for stocks, many have already pointed out that unless we see clarity on stimulus, on tariffs, dollar China is likely to face further upward pressure. Guys.
Thanks so much, Avril Hong in Singapore for us there. Let's turn back to the region, though. Ethiopia has launched its stock exchange, starting with just one listing. It's part of a plan to attract investors to an economy recovering from a civil war. The exchange opened without any brokers and no IPO debuts. For more, let's bring in Bloomberg's Fasika Tadesse, who is in Addis Ababa in Ethiopia. Fasika, great to get you on. You've been following this quite closely. This was quite a delayed opening. We'd been waiting for quite a while for this to actually happen. What challenges do you expect Ethiopia to face in establishing a successful economy and also a successful stock market?
Thank you very much, Jen. So I would say three major challenges. The first one is, as you said, it was launched with no brokers, local and international or foreign brokers. So that could be one of the challenges. The second one is the economic situation of the country. So there is a low FX reserves in the country, and also the inflation rate is relatively high. It was reported to be 17% in December. The other challenge is the political stability in the country. There are ethnic tensions into two of the major regions in Ethiopia, the Amhara and the Oromia region. So these are the major challenges that the market could face.
Fasika, we were just looking at Prime Minister Abiy Ahmed there opening up the stock exchange. Does this go far enough to attract investors into the country? What are some of the challenges that you see there for him?
The first one is, as I mentioned, attracting more foreign investments into the capital market, the new. So it's a relatively new one. We had one back in the 1960s, but it's now, we can say it's a new phenomena for the country. So, and also repatriation of funds has been a major challenge for not only in the capital market, in other foreign investors coming into the country. So they were, because of the low foreign currency reserves, they were unable to repatriate funds into their own country. So that was the major challenge, and that could the foreign investors could face. And there is a law, as part of launching the capital market, a new law has been approved that says the foreign investment or foreign companies will get preferential treatment to repatriate funds, but the additional laws should be put in place to put this into effect. So, which is not come out yet. That's one, and also containing the conflicts that are happening in different parts of the country should also be addressed by the government, which is a key to attract foreign investment into the country and to have a robust capital markets.
Certainly. Bloomberg's Fasika Tadesse following the story closely for us in Addis Ababa. Fasika, always great to get your reporting on. Thanks so much. Now, for a look at some other stories we are following this morning, Bloomberg has learned that Benin is looking to raise $750 million through its sale of dollar bonds, matching the amount it raised last year. Government officials told investors in London that the financing is aimed at boosting the budget. Benin is the first African borrower to tap international debt markets this year. Ghana has scrapped 7 government ministries as part of cost-saving measures under the IMF's austerity program. The West African nation's new government will work with 23 ministries instead of the original 30 to fulfill a pledge for a leaner and more effective administration. Ghana sought a $3 billion bailout from the Washington-based lender in 2022 as it struggles with debt payments. And it's reported the UK has agreed to a request from Mauritius for a front-loaded payment of lease compensation as a sweetener to the Chagos Islands deal. According to the Weekend newspaper, a joint statement on the £90 million a year agreement could come as soon as today. The new Mauritian government, elected in November, reopened the deal unveiled a month earlier, questioning whether it delivers all of the expected benefits.
And moving to California now, at least 2 rounds of hot, dry Santa Ana winds are expected to blast through Southern California earlier this week. The powerful gusts are expected to challenge fire crews struggling to contain 2 destructive blazes and could force thousands more residents to evacuate. For more on this, let's get out to Los Angeles and speak to Bloomberg's Lucas Shaw. Lucas, it seems as though Southern California is still very much in a state of high alert. What is the current situation on the ground with looking to control these wildfires?
Yeah, and thousands of firefighters and first responders have spent the last several days working to contain 2 massive fires. The winds have calmed down a little bit, which has enabled them to make some progress. The largest fire is the Palisades Fire, which has destroyed more than 20,000 acres. It's posing the biggest challenge. It's less than 15% contained, but that's more than it was a couple days ago. It's already destroyed one heavily populated beach enclave and has threatened a few other towns. We're waiting to see on that. Firefighters have had more success containing the second one, which is Eaton Fire, which is frankly the one closer to where I live. It's destroyed a middle-class neighborhood and some other areas. It's in the foothills of a national forest. That's now about 25% contained, but we're all waiting to see what happens as the winds pick up later this week.
And as we were speaking, the losses and estimates for economic damages continue to mount. Just give us a sense for how much destruction these wildfires have caused, both in terms of fatalities, in terms of buildings lost, and in terms of broader economic damage as well.
Yeah, so look, it's too soon to know the full extent, both because people are still working through the wreckage and because there are active fires. Estimates so far put the damages probably at least $50 billion. I think the deaths are around a couple dozen, but that number is moving, and it's thousands of structures. Probably going to end up being the most damaging combo of fires in California history. Insurance companies alone estimate they could be on the hook for about $20 billion. And many homeowners don't have insurance anymore because, especially in the Palisades, that was an area sort of deemed uninsurable by some because it was at risk. But we're still figuring out what the full extent of the damage is. I think everybody who lives in the community knows at least a few people who've lost just about everything.
Yeah, really tragic scenes there. Bloomberg's Lucas Shaw in Los Angeles. We appreciate your reporting. Thank you. Coming up, China's trade surplus soared to an unprecedented $992 billion in 2024, driven by record exports and weak imports. We'll discuss the latest trade data next. This is Bloomberg.
Welcome back to Horizons Middle East and Africa. I'm Jennifer Zabasaja in Johannesburg. China's trade surplus reached a record $992 billion in 2024, driven by record exports and weak imports. The surge in exports may be short-lived, though, with President-elect Donald Trump promising higher tariffs on Chinese goods. Let's bring in Bloomberg's China correspondent, Min Lo, who's joining us from Hong Kong. Min, this is welcome news for China. What does this tell us, though, about the state of the economy?
Yeah, we see exports really ending the year on a high, 10.7% growth on year, a big B compared to the forecast of about 7.5% growth on exports. Also a beat when it comes to imports, coming in at 1% growth compared to forecast of a decline of 1%. But what this tells us is 2 things. One, you see that big divergence between exports and imports, again reflecting that 2-track recovery in the economy, very resilient over overseas demand, but very weak domestic demand. That is still at play here. And number two, that big beat on exports, likely because of these exporters front-loading shipments to the United States ahead of potential Trump tariffs. So this is likely to be the last high point in Chinese trade, at least with the U.S., because when Trump tariffs kick in, it will likely force these exporters to diversify their trade away from the U.S. to other countries. Bear in mind as well, we are looking at export prices that have been declining because of this downward pressure on prices because of weak domestic demand. So if you look at overall, although the export volume has gone up through November, it was up 7.3%. But if you look at export value, though, that has gone up only about 5.4%. So not as high as the volume there. But still, look at the overall trade surplus. That is a record over $990 billion. Again, that's likely to be a factor that will perhaps continue to intensify trade tensions with China's partners.
And Min Min, happening at the same time, UK Chancellor Rachel Reeves has tried to assuage the market concerns over the UK's fiscal position during her trip to China over the past few days. She reached deals worth just over $730 million over the next 5 years. What are the deliverables that we are seeing? What are the other deliverables that we are seeing from this trip between China and the UK?
Yes, so this was a trip that is meant to revive high-level bilateral talks that has been put on hold since the COVID-19 pandemic. And Rachel Reeves was there in China along with the BOE governor, as well as some senior executives from the big banks like HSBC and Stanchart. And she met with the Vice President Han Zheng, Vice Premier He Lifeng, who is China's economic czar. And the two sides agreed to a series of deals amounting to about £600 million over the next 5 years, including plans to deepen financial services links between the two countries, for instance, by enhancing the Stock Connect. The two sides are looking to conduct feasibility studies for an ETF Connect and a Wealth Connect as well. And both sides also looking to stop or to lift some of these export bans, especially around areas related to some of the agri-food business sectors, which could help create more jobs for the UK. And this trip is particularly important for Rachel Reeves and her government, which has been promising to continue to pursue growth, and China is at the center of that. They want to attract more foreign investments. They want to improve trade at a time when the UK's trade with the European Union has been going down by millions of dollars a year, according to a think tank, ever since Brexit. And as you said, there has been a lot of pressure. Her government is under pressure to either decrease spending or raising taxes. But she has reiterated that she is going to meet the conditions of those self-imposed fiscal rule in the budget. But for China, it is part of their sort of overtures to other countries, including the likes of India, Australia, Japan, for instance, just ahead of Trump's inauguration. As a sort of backup plan, if you will, to counter those Trump tariffs, China will need to seek shelter from other markets beyond the U.S. So they are also intent on sort of stabilizing and improving relations here with the UK as well.
Bloomberg's China correspondent, Min Min Lo, thanks so much for your reporting and for joining us as always. Now, for a look at some of the other stories we're following this morning, the party of Chad's military leader, Mahamat Deby, has reinforced its grip on power by winning 2/3 of the seats in parliamentary elections, which were boycotted by the main opposition. The results come days after an attack on the presidential palace in Chad's capital, which killed 20 people and injured several others. Mozambique's opposition leader, Venancio Mondlane, has called for renewed protests next week that will clash with the inauguration of the country's newly elected president, Daniel Chapo. Mondlane returned to the capital, Maputo, last week after nearly 3 months of self-imposed exile, during which he led protests against the election results he says are fraudulent. A local monitoring group says almost 300 people have died in the unrest since October's election. Now, coming up, oil climbs to a 4-month high as a fresh wave of U.S. sanctions against Russia threatens to hit supplies. We'll discuss the impact on crude flows next. This is Bloomberg.
Welcome Welcome back to Horizons Middle East and Africa. I'm Jumana Bersachi in Dubai. Oil is trading around 4-month highs as a fresh wave of U.S. sanctions against Russian energy raises supply risks. The latest curbs are the most aggressive and ambitious yet, targeting large exporters, insurance companies, and more than 150 tankers. Stephen Chasinski leads our energy coverage in Singapore and joins us now. Stephen, why did the oil market jump so much on Friday, up 4%? Because we know that for a while, Russia has been curtailing many of these sanctions with their shadow tankers. Why is this time expected to be different?
This is the first time they've really come out against the shadow fleet in a big way. This is by far the largest sanctions package against these vessels that were kind of operating sort of between the lines of the market and was allowing for the oil to flow to places like India as well as China. Now, I also want to preface that the U.S. had held off largely on sanctioning Russian oil directly. For a long time, they had this price cap, which famously they were pushing different countries to buy below a certain price to help reduce the profits going into Moscow while also allowing the oil to continue flowing into the market. Now, with this latest package, not only did they hit the tankers, but they also hit oil exporters. They hit about two companies that handle about 30% of the flows out of Russia. They've hit insurance firms. All those things together, Goldman estimates, could take about a little bit less than 1 million barrels a day off the market if it's actually seen to its fullest extent. And that's about 1% of global oil supply. So all of that together does add this sort of bullish element. Now, the big question is, how effective are the sanctions? As you alluded, Russia, Iran, many other countries have been able to get around U.S. sanctions, and it really depends on what the Trump administration does from here and how much they push it.
Yeah. How much of the price move do you think can just be drawn back to the fact that many people were quite bearish the sector and were probably positioned short?
Yeah, I mean, that could be a case. We've seen net longs jump week over week. Even before this sanction package came out, there was sort of this more bullish sort of element coming into the market that maybe prices fell too far too fast, because also with Biden coming in, with Trump coming in, there could be potential Iranian curbs. There are also falling U.S. stockpiles, and the weather has been draining that storage because of the colder weather, and there's more cold in the U.S. on the way as well as potentially in Europe. So all those things together were already kind of pushing prices up. But then on Friday, with the sanctions package being announced, you really saw that spike, and then continuing to a degree today as well. Therefore, perhaps there's still some more upside. Goldman says that if you could take 1 million barrels a day off the market from Russia, you could see Brent, which is now around the low $80 range, jump up above 90. So there might be still some upside, but still, it really depends on a lot of factors and whether or not the sanctions are effective and if the Trump administration keeps them in place when he takes over later this month.
Stephen, as ever, thank you so much. Big moves we're witnessing in the oil markets, with Brent trading close to $82 now. When I went on holiday, it was close to $70. So a lot can happen in 2 weeks. Stephen Chasinski, who leads our energy coverage in Singapore. Well, it has been quite a disruptive start to trading for the first couple of weeks of the year. This is the picture for S&P futures and NASDAQ futures now. So you can see that we are still building on some of the losses that Wall Street witnessed on Friday after that bumper NFP print. S&P down 1.5% on Friday, down 2% for the week last week. Its worst week since that Fed December meeting where they surprised on the hawkish side. So that hawkishness of the Fed is having an impact on equity markets this year with year-to-date losses for the majors. But as we spoke about, there are going to be some big events to watch out for this week. We've got U.S. inflation. We also have UK CPI numbers to watch out for. And the reason I mention that is, of course, there's been a lot of focus on what's been happening with UK yields, with gilts, as well as Rachel Reeves, the Chancellor, returns back to the UK. And then keep an eye on earnings season. It begins this Friday with some of the big banks reporting. So that's going to be in focus. But the market will continue to pay a lot of attention to what is happening happening in the yield space, with 30-year yields briefly touching 5% on Friday. We've got 10-year yields trading at around 4.75% in yield terms here. And so that's going to be a big driver for market direction from here onwards. But that is it for Horizons Middle East and Africa. I'm Jumana Bersachi in Dubai with Jennifer Zabazaja in Johannesburg. Stay with us for Daybreak Europe. This is Bloomberg.